Thank you, Emily. Can everybody hear me okay? I know it's pretty noisy out there. What I'm going to do is I'm going to split it up with Phil Mckellar. Phil has worked with us for about half a dozen years, just do it simply. He actually moved to Toronto to work with us. He loved the city so much that he has moved back to Victoria. On Saturday, the moving vans were unloading him. So he's going to talk about some specific stock selections. He manages the vice president portfolio with my business partner, Ben Stadelman. And then once he comes off, I'll come back on and add a few notes. I'm just going to mention, I'll try and remember after, but I may not. Afterwards, if anybody wants to come and talk with us, because they're going to kick us out at 20 minutes, we're going to MRG right here, the meeting hall. You're welcome to join us. We'll sit and talk. And if anybody hasn't collected the two handouts here, there's a couple handouts, absolutely free. So Phil, you're on.
Thank you, Benj, for that introduction, and thank you all for coming here this morning. As Benj mentioned, I co-manage the Vice President portfolio at Contra the Herd with Ben Stadelman. What I'm going to do in the interest of time is give you a brief overview of our methodology, and then I'll walk through some picks that we have in the resource sector. So, as the name Contra the Herd implies, we are a contrarian newsletter, which means we're looking for undervalued companies and sectors that are very beaten up, unloved, and unliked. Once we have established those kind of sectors and criteria, we take a very close look at the balance sheets of the companies that we're interested in. We look at things like the insider ownership, and we try to gauge a catalyst. A catalyst could be on the macro side of things, or it could be something very specific to the company, like developing a new project, hiring a new management team, and that sort of thing. So that's a very brief introduction to our methodology and what we're kind of looking for. And if you have any questions about that after we're done, we can try to answer any of those questions for you. So as you know, this is a mining and resource conference. And today in the market, mining and resource investing is one of maybe 5 sectors that I can find which are undervalued and look attractive. So within that space, we've taken a kind of diversified approach in the Vice President's portfolio, and I'm going to share 3 of those names with you. The first one is Sprott. So Sprott is listed on the TSX. I don't know if they have a booth here today, but they're a very well-known name. And what they do is they are an asset manager in the resource space, and they engage in financing for resource companies. So they're an interesting company from our point of view because they have the wind at their backs right now. Last year, they divested from their non-resource businesses to focus purely on the commodities space. They also completed the purchase of a bullion fund here in Canada, which now makes them the 3rd largest bullion fund complex in North America. And in the asset management business, scale is very important. So we like those kind of catalysts that are going on at the company. So the other thing that's nice about this company is that because it's so diversified with its management team and its investments, it's a broad-based play on a recovery in metals and mining. And it's a way to do it without getting down into the nitty-gritty of every single investment out there. You're essentially hiring an investment team to do it for you, and instead of paying a mutual fund or an ETF and MER, you are being paid a dividend as you wait. So that is a very attractive prospect for us. The second investment that Ben and I have made in the Vice President's portfolio is a company called Major Drilling. Major Drilling is one of the largest drilling service companies that caters to exploration mining outfits and large operating mining outfits. So they call those 2 kinds of drilling specialized and conventional drilling. Kind of in the same ilk as the Sprott investment. An investment in Major Drilling is also a diversified bet on a recovery in the resource space. When mines are in need of drilling, it's like when there is a construction boom and everybody needs a plumber. It's the same kind of philosophy, and the company's margins should do very well when that change or turn comes. I should point out, though, of the three investments that I'm mentioning today, we're underwater on this investment. We paid about $7.50 for it, and it's currently just under $7. So we are underwater on that, and it hasn't made money for quite a long time. And one of the major reasons for that is as they scale into the next cycle, the cost of labor increases before you get the margin and the return from the mining companies. So they're facing some headwinds, but as with Sprott, we think it's a good diversified bet on a recovery in resources. The third company that Ben and I have invested in is a company that Benj has also invested in. It's called Gallander Gold. Gallander Gold is listed on the TSX as well, and it is based in Turkey. They are a mining operation in the eastern part of the country, and they're currently undergoing a very large expansion project at their mine, which is called the Mckellar mine. So the Mckellar mine has been an oxide mine up until this point, and they now have a huge sulfide reserve, which they need to convert into cash and money. And what they're doing is they are building a big, huge facility to process that sulfide. So the timing here, looking for the catalyst, the timing of this project should be complete in the third quarter of this year. And unlike many mining projects and mining expansion plans, this project is on time and it is under budget. So it is quite an interesting prospect from our point of view. The issues associated with Gallander are a few-fold. The obvious one is that it's in Turkey. And Turkey is a risky jurisdiction, as I'm sure many of you know, and I don't think that's going to change anytime soon. So investors who are interested in a company like Gallander have to be fully aware of its location. The second issue with Gallander is the fact that it's a mono-mine operation. It only has one mine. So if for whatever reason there is an outage at the mine, if something goes on at that specific location, there is no other mine that they have to offset that loss, and they could have an operational bottleneck, an issue associated with that. In the long run, they plan to develop other mines, but for the foreseeable future, and I'm talking out until 2022, 2023, they're going to remain a one-mine operation. So those are our three picks in the resource space that Ben and I manage. And as I mentioned, Benj has also invested in Gallander, and I know he's looked at major drilling in the past, and I don't know about Sprott, but those are the three kind of picks. So in summary, those picks illustrate our approach. The upside on all of them is quite high, at least 100% based on our way of valuing companies. The valuations are good in each case. The balance sheets in each case are strong as well, with very little debt. The only one that has debt is Gallander, and that debt is associated with their project. And they are diversified bets on a resource recovery. So they are a good way, unless you're an exploration geologist, a good way to get your hands into recovery in the resource sector that may or may not unfold. So that's really all I have to say, and unless Benj has anything that he would like to add, we would be happy to take your questions.
Thanks, Phil. So people often ask how we do research, and we try and talk to management, meet up with management. In the case of Gallander, what Phil didn't mention was about a year ago he went over to Turkey, and he looked at their operation and was on site with management and getting a good framework of who they were, what they did, how they were doing it. We've also met with them at PDAC, which is I think the largest mining show in the world that happens in Toronto, and talked to them there. But Phil was right there. So it's very important when you're investing in any companies to do a lot of different kinds of research, looking at numbers. Phil said all three Two of the three companies have no debt. We're always looking at risk and reward. If a company has no debt, it really knocks down the risk, to be sure. So when I was speaking here, say 10 years ago, the world was a different place. We're entering a huge recession. People had lost an awful lot of money. It was very glum out there. But hopefully a lot of you have made a lot of money over the past 10 years. And hopefully you've made so much money you're trying to think of what to do with it. So I'm going to quote a guy you might have heard of named Warren Buffett. And Warren said, "It's nice to have a lot of money, but you don't want to keep it around forever. I prefer buying things. Otherwise, it's a little like saving sex for your old age." So it's important if you have money to think about spending it and using it. I'm very, very debt averse. Very debt averse in my investing. I never buy on margin, have never bought on margin. By doing that, I reduce risk dramatically. In life too, one of the best investments you can make is if you have debt, pay it off, to my way of thinking. If you do that, the bank can't come to you. I used to do a lot of turnaround stuff. I did a turnaround at a publisher years ago, going back to 89 to 91, and they owed a lot of money to the bank. They owed a lot of money to computer dealers. They owed money to printers. They were in very, very bad shape. So I met with everybody and I said, "We'll pay you off at 100%. We just won't give you any interest." So the computer guys who had the Apple store said, "Well, I can put you into bankruptcy." I said, "Go ahead if you want to, but you take back those old computers, you know how much you're going to get on the dollar." So I said, "I'll give you 100%, I just won't give you interest," which I felt was very fair. The printer who we owed a lot of money to, I said, "We'll pay you back over 2 or 3 years." CIBC Bank, they were really tough because they were calling in the money. And I said, "We'll pay you back over time too, but it'll take time." They were going to take their interest anyhow. Once we paid them back, they said, "Well, why don't you take out another loan?" I felt like giving them the big golden finger, but I didn't because I'm a nice guy. And I just said, "No, we won't go into debt again." So a lot of people say, "What do you recommend in stocks?" And what Phil's recommending are things that we strongly believe in. But I believe even more strongly, pay off your debts before investing in stocks. So the commodity sector has come back a long way, maybe not gold, but a lot of the other commodities. But it has changed dramatically over the past few years because of two major competitors. Somebody want to tell me what one or both of the competitors are? What's that? Yeah. So he mentioned cryptocurrencies. So people who like exciting stuff, they may think gold or they may think cryptocurrencies. What else? Marijuana. Now it's interesting. So if you want to talk to two guys, he's the crypto guy, he's the marijuana guy, don't let the white hair fool you. Or maybe, back in the 60s, I don't know. So those two fields, for people who want to make money potentially quickly, if you get it right, you could do really well. Now, a lot of you know me from BNN. You might not know I'm on CBC a couple times a month. Peter Armstrong on the Money. So on that show, I've talked a lot about marijuana, a lot about cryptocurrencies, a lot about AI and other things. In both those areas, you have to be very wary, crypto and marijuana, because if we went back a year, I don't know how many companies there were in crypto, but I'd say less than 500 easily. Somebody want to tell me how many cryptocurrency companies there are now approximately? You said 1,700. Yeah, so you're moving towards 1,700. They're growing like crazy. Let me tell you that many of them, and there's lots of articles, are just there to make money for the people who start them. In mining, you can make a lot of money, but you also have to be wary. There's a lot of companies where you're not going to make money, others that are great investments. When we made a huge amount of money was in the last turn. We had a lot of Kinross gold buying under $5, Inmet gold under $5. I know Kinross is around 5 now, but it went way up. So we made huge amounts. Ore Resources, we paid $1.81. So one of the best ways to make money are when the sectors are way out of favors. So in the system I use, and I've got when we go over there, I've got a couple of the books to sell. I give sectors 1 point for being out of favor. And right now, commodities are still relatively out of favor. I don't personally believe gold is a flight to safety. I also don't believe in the US dollar as a flight to safety because the US deficit is so bad, their debt is growing so quickly. Their president, Trump, that's his name, Trump, he has come in with this new tax plan that's going to increase the debt dramatically by another $1 trillion or so. So they're going to be in worse and worse shape. Yes, they're repatriating some funds, but to go into further deficits, further debt when economies are doing well, of course, Canadian governments would never do that. They're too smart, is stupid. When you've got high employment rates, we've got the highest employment rates in the US and Canada, and you're talking basically 20 years plus, that's when you want to be paying down debts and deficits. So I actually think in many ways we're in worse shape than we were before the last recession. And when I'll say it, the shit hits the fan. I'm sorry if I offend anybody. When it does, it could really come off the rails. Some of you may know there's a pattern in the US banking system. Every 10 years ago, they have problems. Saving a loan, 10 years ago, the banks. I have in the portfolio I manage, about 28% is in US banks. If you'd asked me last week, it was more 32, 33%, but I sold part of one on Friday. So you just have to be wary. So I have like 2 minutes left, and I know I have to get off quickly. I'll just say, for those of you who don't know what we do, there's the 2 handouts over there. We publish quarterly. We send it by Canada Post. In the center spread, it shows all the stocks we have in both portfolios. But when we buy or sell a company, we send an email. So on Friday, as I said, we sold something. So before markets opened on Monday, we sent an email. We had bought this company at an average price of 8 and change, most of it at 7 and change. But they did a rights offering, so we subscribed to it 11 and change because the stock was around 14 when we subscribed. So we sent an email saying we sold at $21.70. That's the kind of thing we like, is an average purchase price at 8, sell at $21.70. We bought it in 2014, and the rest, I think, in 2017. Getting gains of 100, 200, 300, 400% plus. And we said, here's why we sold 33%. Here's why we're still holding it. Obviously, we think it could go further, but we wanted to take some of that money off the table. Thank you all for coming. I also want to thank Jay Martin, who puts together the show, and Daniel Fleck, who's my major contact. If you want to come over there, you can, and there's handouts there.